Hello there. Well, markets have taken a bit of a positive turn recently, and that's mainly, or partly at least, because a lot of the economic data we've been seeing has actually been just that little bit better than people had expected, or perhaps we should say less bad than many people had expected. Some of the doom and gloom headlines we saw towards the end of last year, well, perhaps, hopefully, they've proved not to be true, and maybe things in the sort of real economy have been slightly better than people had thought. But crucially as well, that economic data has not been too good. And you might say that's a bit strange. Why don't we want economic data to be too good? Well, you may have heard us say before that sometimes actually good news is bad news, and sometimes bad news is good news when it comes to the economy and markets. And that's because a lot of the returns from equities and particularly bonds at the moment are being driven by interest rates. If we got some really good economic news, the economy was booming, that unemployment was falling and everything was great, then actually that might encourage central banks to put up interest rates even more than they have at the moment. But of course we don't want to see, on the flip side, we don't want to see economic data that's too bad either. That would mean that company profits are falling and all those sorts of things. So it's at the moment the kind of, we call it kind of the Goldilocks zone at the moment, where the data is not too hot, not too cold, and that's really supportive for markets. But it's quite a fine line, so we would kind of expect at some point this year we probably will see some volatility, because some of those data points are going to disappoint at some point. So what would we like to see? Ideally from a purely investment point of view, we would probably like to see, well, firstly we want to see inflation falling, preferably quite quickly, more rapidly than people thought. Energy prices continue to come down, goods prices continue to come down, but now we need to see sort of a bit of a slowdown, a small slowdown in consumer spending, which would then help services prices to moderate as well. That would be helpful. And then secondly, what we'd like to see, again from an investment point of view, is a little bit of a softening of the jobs market, which is a bit of a euphemism to say sort of rising unemployment. Now, obviously, from a human point of view, that's not great, but that's one of the things that the Federal Reserve, in particular in the US, is looking at when it's trying to decide what to do with interest rates. It's how strong is the jobs market. At the moment, the US jobs market is still pretty strong, but we have seen some tentative signs that might be turning around a little bit. For example, some of the big tech firms have recently laid off quite a few people, generally the people that they'd recruited over the past couple of years, just laying them off again. And that, of course, can be helpful for their share price, because it means reducing some of their costs that then can help boost profit margins as well. So it's a very kind of mixed, very nuanced picture at the moment. It's very difficult to see where things are going. As I say, it wouldn't surprise me if some of that data at some point disappoints, and therefore stock markets could take another leg back. Still quite optimistic, given it a longer term view, but just shorter term feeling a bit more cautious. However, we do think at the moment, as I've said in sort of previous editions of the Pulse, we do think corporate bonds is not a bad place to be right now, unless the economy takes a really steep turn for the worse. Then we think corporate bonds, where you lend money to companies, should produce a decent return. We just need to make sure those companies don't go bust and they can afford the interest that they pay on those loans. And even if we see the opposite and interest rates carry on going up, well, we think a lot of those corporate bonds now pay a high enough yield to sort of compensate us for that risk too. So, like I say, feeling cautiously optimistic at the moment. Things are definitely looking a little bit brighter, but we could see a little bit more volatility ahead. So we'll be wary as usual, and we'll be ready to make changes if required. So thanks a lot. See you again next time.